Hello, this is Jeff Liebig with Douglass and Liebig, and I'd like to welcome you to today's webinar on the Tax Cuts and Job Act of 2017. It's been in the news a lot. I'm sure a lot of you have heard different pieces of the act and what it might mean for you. We're not really sure. It's going to affect a lot of different taxpayers in a lot of different ways. What we've tried to do is trim this down to focus on the particular areas of the act that we think are going to affect our clients. So as you listen to today's presentation, keep in mind that this is really more or less a high level. There are a lot of pieces of this particular Reform Act that may affect one or two of our taxpayers, but that don't affect the majority. So we didn't try and cover all of those. The other big piece is today, January 25th. And as of today, there are still a lot of changes to happen in this act. What we're seeing is when Congress was writing this particular act, they were in such a hurry that they didn't have time to see how each piece was going to affect something else. So they wrote phrases, provisions in this act that actually contradict with tax law that they don't want to contradict, or even contradict with other pieces of the Tax Reform Act itself. So what's going to happen is over the next several months, we'll see what they call technical corrections. And these are going back in, it'll either be Congress, some staffers, the Internal Revenue Service, going back in and trying to clean all of these things up. The other thing with this act is that there are some provisions that had unintended consequences. And because of that, those need correcting. So what we're trying to do is give this out to our clients to say, hey, be aware of these things. We're not going to do a tremendous amount of planning over the next several months because we just don't know where everything exactly will shake out. But what we will be doing is scheduling times after April 15th to sit down and start looking at what the impact of this particular act is on the individual client returns and taxes. So, and at that point too, we'll be discussing some strategies. What's the best strategy to look at this particular act and decide how are we going to minimize your taxes moving forward? So all that being said, let's kick this off. Hopefully you've got some caffeine or something to keep you awake because this is not exciting stuff. This is really focusing on the business piece. So as we kick off the business piece, what I want to start with is talking about the effective date. So generally speaking, the changes under the Tax Cut and Reform Act, or Jobs Act, start and are permanent beginning after December 31st, 2017. And I always chuckle when I see the term permanent because nothing is ever really permanent. As we can see, tax law changes all the time, but at least nothing is set to stop. So the next big thing is corporate tax rates. Corporate tax rates were reduced from a high of 35% down to a flat tax rate of 21%. And the same rate applies to personal service corporations. So if you were what was considered to be a personal service corporation in the past, those are attorneys, accountants, doctors, engineers, those professions always paid a flat 35% rate. In the past, if you're corporate, and this is a C corporation, but the corporate taxable income was under $50,000, you only paid at a 15% rate for that first $50,000 of taxable income. That goes away. So this is one of those places where we're actually seeing where taxes are getting increased through this Tax Reform Act. The next one. So I think a lot of people have heard about this whole idea that flow-through entities are going to get a 20% deduction. Well, the complicating factor here is how do we calculate the deduction? In theory, it sounds pretty easy at 20% of my income. But it's like with most things in the tax law, it's never quite that simple. So what we have to have is this new concept called qualified business income deduction. And what it is you've got flow-through entities, which are S corporations, partnerships, sole proprietorships, that's your Schedule C, also real estate investment trusts and cooperative dividends, publicly traded partnerships, all fall into and have to calculate this whole idea of qualified business income. And what happens is that qualified business income is calculated for each one of your entities. So if you have multiple flow-through entities, each one calculates its own qualified business income. You add all of those up together, so some may have income, some may have losses, and you net that out, and that's the determining factor for your qualified business income deduction on your individual tax return. What does this mean? So qualified business net income is the net amount of qualified items of income, gain, deduction, and loss, but only to the extent included or allowed in taxable income for the year. So what we're starting to see with that is where you have passive activities, so maybe you don't get to take all of the losses or such on your rental real estate, that all goes into the calculation first. The other thing is QBI may not exceed taxable income reduced by capital gains. It only qualifies from U.S. trades or businesses, and losses for QBI have to be carried forward and reduce next year's QBI deduction. So again, this is how QBI, this qualified business income, flows through to your individual tax return. And if it's a loss, and that is not offset by income from other entities, that loss carries forward. So next year, it may minimize the amount of the deduction you get if you do have income. So again, this is a really big planning opportunity for us. We want to talk to you about that. Qualified business income doesn't include investment income. So on your flow-through entities, if you have interest, dividends, if you sold some equipment and have a capital gain, commodity gains, some other things like this, those do not get counted when we look at what your qualified business income is for calculating the deduction. So for example, if your net income in the business is $100,000, but let's say that $20,000 of that is from interest and dividends, we are only allowed to calculate that 20% qualified business income deduction on the $100,000 less the interest and dividends of 20. So that's $80,000. And we would get the 20% deduction on that 80, so $16,000. So it is, as you can see, a very interesting thing that Congress has come up with in this whole concept of a qualified business income deduction. So when we look at your S corporation, qualified business income must be reduced by reasonable compensation. So we've always talked with our business owners about S corporations and having a reasonable compensation. So that's your W-2 pay versus what you take out of your S corporation as a draw. What we're seeing here is QBI has to be reduced by qualified reasonable compensation. So if the net income is $100,000, that needs to be after deducting the cost of your salary. If it's a partnership, QBI must be reduced by guaranteed payments, and QBI also includes both passive and active income. Now we get into, as much fun as that was, talking about qualified business income, now we talk about additional ways in which it's limited. As I said before, it's never as simple as it sounds. Now we're getting into additional limitations on that 20% deduction. We also look at what W-2 wages were paid out during the year. And what we're seeing is that there's a W-2 wage limit. So going back to that $100,000 of net income, if your business only paid $5,000 of wages and the rest of it was expenses for equipment and rent and all those other things, your limitation is going to be 50% of the $5,000 of W-2 wages are $2,500 for your deductions limitation instead of the $16,000 we just talked about. On the other hand, if you're a rental real estate owner, so commercial real estate is usually we're going to see a lot of this, or a residential real estate holding. Now you look at sum of 25% of W-2 wages plus what we call 2.5% of unadjusted basis of qualified property. And you might think, and hopefully your eyes haven't glazed over completely by now, but what we're talking about here is 2.5% of essentially what was the purchase price of the property. So in other words, for $1 million building, $25,000 would be the limit that we're talking about here for the 2.5%. And if for some reason in your commercial building you're paying out W-2 wages, that would be included as well. So 25% of the wages plus 2.5% of the unadjusted basis of the property, that gets us the potential 20% deduction. Now we get into some additional limitations. Specified service businesses. So now we say that these particular types of businesses don't get the 20% deduction at all. So now PSC, which are personal service corporations or personal service companies, except for engineering and architects. So those specifically got excluded in this act. As near as we can guess, it is because it's perceived that engineers and architects contribute to the building of something. The other personal services would be athletic services, financial services, brokerage services, any business where the principal asset is the reputation or skill of one or more employees. So now we're thinking that this could actually wrap in real estate professionals, real estate brokers. So we're getting into some areas where we're absolutely waiting for some technical clarifications to see exactly what this is going to mean. Right now, it's a very broad description, and we're looking for some clarification from Congress or the IRS on this. Oh, but wait a minute. Check this out. So if the specified service business income is below $315,000 for a married filing joint return, then if you're an architect, excuse me, let me start that again. So wait a minute. Here's an exception to that rule. So I just got done telling you that personal service type companies don't qualify, but they gave us an exception. In this case, it is if the specified service business income and your taxable income as a result of that is below $315,000 as a married filing joint tax return, you actually get to take the 20% qualified business income deduction. Now, it still has some of those other limits, like the W-2 wage limit and things, but the specified service business limit doesn't apply to you now. So if you are one of those personal services, you can get the deduction as long as your income is below $315,000. If it's between $315,000 and $415,000, it actually just phases out over that $100,000 spread. Over $415,000 of taxable income, you absolutely will not get the deduction. So that's really the way this works. You can see here's a slide showing for married filing joint and single how those limits are actually applied and when they phase out. So when we look at the idea of qualified business income and the deduction for it, keep in mind that if you are a Schedule C or a sole proprietor and you're paying self-employment tax on the net income of your business, QBI deduction does not reduce the income for calculating the self-employment tax. It's also not going to reduce adjusted gross income. This is important because some limitations are driven off of your adjusted gross income. So it's going to be interesting, again, to see how some of these things play out. We haven't even been able to construct a good, solid model that we can use to explain and show this to our clients, and also do some calculations on how it's going to affect you. But we will be getting those things together over the next several months as these technical corrections get finished. So that's really the pieces of this puzzle that I'm going to cover. And now I'm going to have Burt Douglass step up, and he is going to finish out the discussion on tax cuts and job acts and how they affect businesses, and in particular our clients. So thanks for joining on this.
Hi, this is Burt Douglass with Douglass and Liebig. I'm going to be continuing with the changes for business owners. So one of the first items that I want to review with you is there is some change in the like-kind exchanges. And this is also known as Code Section 1031, if you're familiar with that. First of all, the rules used to pertain to personal property and real property. Effective in 2018 forward, the Code Section 1031 like-kind exchanges no longer apply to personal property. And what this means is, let's say that you have a vehicle that we have fully depreciated, but then you take that vehicle and it has a $15,000 fair market value, and you exchange it, you trade it in for a newer vehicle. Well, now you have to recognize that fair market value or the trade-in value that the dealership is giving you. So this is a big issue, but there are some tax planning opportunities around that. But we still have Code Section 1031 like-kind exchanges that qualify for real property. Please contact us if you are thinking about doing a like-kind exchange while the code section is still retained in the law. There are a couple of things that we have to consider and factor in.
That's great.
Okay, let me go over the changes in meals and entertainment. First of all, they have disallowed any deductions for entertainment, amusement, or recreation. What this means is for golf outings, 49er tickets, Kings tickets, anything like that. However, they've also retained the meals deduction at 50%. So you can still deduct that if you travel for business, if you take clients or business owners out for meals, dinners, lunches, things like that. What we're finding is that there is no longer a deduction for meals provided for employers' convenience. Remember, previously I would recommend that you bring in a lunch to your establishment. We could deduct 100% of that lunch. That has gone away. I think the reason for this, Jeff and I have talked about this a lot, the reason for this is probably because of the Google cafeterias, the Twitter cafeterias, Amazon cafeterias. The employers would provide these cafeterias for the employer's convenience. Well, that meant that the employees were receiving this fringe benefit for free. So we have some changes in this area. Luxury auto depreciation rules have changed considerably. Now keep in mind that the IRS considers a luxury auto anything over, I think it's like $20,000 purchase or something very, very low. But what we're seeing here is now in the first year that you place it in service, we can deduct up to 20% of the purchase price or $10,000. So it's going to be the lesser of those two. And then you can see it jumps in year 2 up to $16,000. This is a big difference over previous law because the limits were so low before. It took us sometimes 10, 20 years to really depreciate the full purchase of the automobile. Now, in order to get to a net tax neutral position, if the government gives us some deductions, like the accelerated auto deduction, then they have to take away other things. And they did terminate the bicycling allowance of $20 that some employers would give to their employees. So I think this is a little silly, but this is our Congress at work. Interest expense. This is a big change. A lot of our clients do have loans or capitalized leases. So the interest deduction moving forward, starting in 2018, is going to be limited. Basically, and again, as I go through this, I'm going to say generally or basically, because for every new law, it seems like there's 30 different exceptions to it. Basically, though, the interest deduction is going to be limited to the interest income that the business owner generates, plus 30% of the adjusted taxable income. So let's say that your adjusted taxable income is $100,000 and your total interest expense is $40,000 for the year. We're limited to take the deduction to $30,000. Now your question is, what happens to that non-deductible $10,000 difference? We don't know yet. We're waiting for a technical correction to get very clear on this. Our thinking, though, is that you may be able to carry over that non-deducted interest expense to future periods. Again, there's more questions than answers with this new tax code. We will inform you as we get technical corrections on this. Interest on floor plan financing. All that means is if you are a dealership or you have a fleet of automobiles that you're trying to sell, that interest that you pay to floor that inventory is 100% deductible. Code section 179. I want to stop for a second and point out that while the qualified property increased to $1 million, the state rules may not have changed. I'll give you an example. In the state of California, we can only deduct under Code Section 179 up to $25,000. But for federal purposes, if you put in place a piece of machinery for, let's say, $300,000, we can elect to utilize Code Section 179 and write off the entire $300,000. Again, this is subject to limitations. So we have to make sure that your net income is high enough to take advantage of Section 179. The other thing that I just want to point out is for large SUVs, we have seen an indexed. The law also changes Code Section 179 to be indexed for inflation as we move forward. Keep in mind, a lot of these limitations were fixed. They didn't change from year to year to factor in cost of living adjustments. So now it is in the law that every year all of our limitations are indexed for inflation. The one big difference in Code Section 179 is it now covers qualified real property. Previously, if I had a client that leased a commercial building and they had to put a new roof on, and let's say the roof cost $39,000, I had to capitalize that and depreciate it over 39 years. Now, Code Section 179 basically says, hey, listen, if it's a new roof and it qualifies under the new real estate rules, you can actually expense the full purchase. So instead of depreciating $1,000 over 39 years, we get to write off the full $39,000 in the year that it's placed in service. A couple of other things I want to point out. Heating, ventilation, air conditioning units, we can now qualify for Code Section 179, fire protection, security systems. So please reach out to us if you're thinking about doing any of this. There's also a couple of tricks to possibly write off the old roof, write off the old HVAC unit as well, but we have to make sure that you're in compliance before we make those elections. In addition to that 179 accelerated depreciation, we now have bonus depreciation, and it's increased temporarily for any property purchased after September 27th, 2017. So some of you, this law will affect when we prepare your 2017 returns, but in the future, we can deduct up to 100% of the property purchased as bonus depreciation. The other big change in bonus depreciation is previously it had to be for new property. Now it's for new or used. So this is very important because a lot of my clients, they might be buying used equipment or used furniture. Now we can qualify that as bonus depreciation. And just note that it does phase out after 2022. Net operating losses, be careful. Right now, we are showing a limitation on the amount of net operating loss that you can use in the current year. And we no longer can carry net operating losses back. We must carry them forward. If you're a farmer, there are a couple of exceptions. And again, I know I'm repeating myself. For every new rule, there's about 50 exceptions to those rules. So we do need to be a little careful. They also made it so that if you can't use a net operating loss, it will be carried forward indefinitely. A lot of you are taking advantage of what is known as the domestic production activities deduction, Code Section 199. If your net income was $100,000 of qualified business income, then I would be able to take a $9,000 deduction from that. So instead of paying taxes on $100,000, you would be paying taxes on $91,000. This has been repealed. We don't see any replacement or any iteration of a replacement as we move forward.